Hi, I'm Rick Ashburn, Chief Investment Officer at Creekside Partners. In an earlier video, we introduced the notion of fair value, which is the price we should pay for an investment if we are to have a good chance of earning the rate of return we expect. Bear with me, this video is a little longer than our other ones, but the message here is the most important thing we can tell you. We mentioned earlier that the rate of return on any investment can be simply stated as the income or earnings received divided by the purchase price. If an asset earns $10,000 a year and costs $125,000 to buy, the ratio of the two is 8%. If we turn that ratio upside down, it's called the price-earnings ratio, in this case 12.5. Now, in order to analyze stocks, we need to know what the earnings are going to be out into the future. We don't have a crystal ball, and the reported earnings of big companies bounce up and down a lot due to business cycles, inflation, and the accounting games big companies play. The annual earnings on the S&P 500 has ranged from $7 a share to over $90 in just the past 10 years. In order to smooth out the volatile short term, we instead look at average earnings over a 10-year period and we adjust for inflation. This gives us a far more reliable indication of what future earnings will be. The best predictor of what public companies will earn over the next 10 years? A simple trend line based on the last 10 years. Now we're in a position to apply our fair value determination. I said before that the PE ratio is stated as the price you pay divided by earnings. If the S&P costs $1,600 and earns $80, the PE ratio is 20. We also call this the multiple, so remember that term. The question now is whether a multiple of 20 is a fair number or not, because stocks are not like real estate or bonds, where you receive lots of regular income. You get a small amount of dividends, but you mainly get your investment return when you sell the stock. So the question of whether 20 is a fair multiple or not really comes down to this, and this is very important. Will someone else in the future also accept 20 as a fair multiple? If that is the case, your investment return will be good, since the earnings will grow, you'll get some dividends, and you'll be able to resell your stock at a good price. If instead, 10 years from now, investors will pay a multiple of just 15 instead of 20, you're going to lose 25% of your investment. Earnings growth over those 10 years will make up for some of it, but you have a big hole to fill. It's like starting a marathon while dragging an anchor behind you. The PE ratio or multiple exhibits a strong tendency to move back to some reasonable value. If it gets too low, investors will snap up stocks and drive it up. When it gets too high, market corrections push the multiple back down. There is no inherently correct number. All we can do is look back at history and see what's happened in the past. On this chart, I've plotted the multiple for stocks over the past 100 years. It's been high and it's been low. It has averaged around 16. There are peaks evident just prior to the Great Depression, in the mid-1960s, and again at the tech bubble in '99. If you pick a point on the graph and assume you bought stocks on that date, you can then move your finger along to another point and see if the multiple was higher or lower. You'll quickly see that whenever you might have bought stocks at a multiple close to 25, you've generally had to sell them for less at a later date. In fact, there were only 3 episodes in history with a multiple that moved close to or above 25, and all of them ended badly. As we record this video, the multiple on the S&P 500 is touching 25 for just the 4th time in 100 years. We can ask our database a simple question. What has been the average inflation-adjusted return on stocks in the 5 years following a multiple of 25 or higher? The answer is negative 1.2%. So think about that for a moment, because the stock market is priced right now at a level that has almost always delivered bad results. This is the core principle of value investing. Do not blindly buy assets regardless of their prices. Pay too much, you will be forever disappointed. Pay the right price, and time will take care of you.